JP Morgan, Goldman Sachs Group, Morgan Stanley, and the World Bank just dropped their latest 2026 investment outlook. But here's the plot twist. They are literally contradicting each other on the biggest cause. So, who's right? Truth is, asking which one is more credible is the wrong question. Today, we are going behind the headlines to uncover what their bias is, and more importantly, how you can filter the noise, get the real signal, and build an unshakable, independent strategy that doesn't rely on any of them. Hi guys, I'm Steven. I share insights on mindset shift and financial knowledge learning for confidence and success. I will show you how to use financial knowledge and different perspectives to understand the world and build a better life. Okay, at first, let's see those so-called giants' investment outlook in 2026. Investment outlook in 2026 from different institutions. Morgan Stanley's outlook for 2026 is generally positive, especially for US stocks, driven by strong earnings, AI-fueled productivity, a favorable policy mix, and a potential jobless productivity boom, easing inflation. Though they anticipate micro shifts and challenges in other regions. They project the SP 500 could reach $7,800, with optimism centered on sectors like financials, industrials, healthcare, and AI-related tech. Goldman Sachs Group's 2026 investment outlook is positive, forecasting sturdy global economic growth with U.S. outperformance supported by easing monetary policy, broadening equity markets beyond tech, and continued AI benefits. Though they know high valuations require careful risk management and focus on fundamentals, they see robust GDP, potential Fed rate cuts, and a wider range of stocks benefiting from tech growth, but caution against overly aggressive positioning due to high market valuations. World Bank's 2026 investment outlook is pessimistic, not purely pessimistic, but it's cautious, highlighting slow growth, risk from trade war, geopolitics, US and China tech race, high debt, and uneven recovery, with projections showing a slowdown from earlier estimates, though some see potential for AI-driven boosts. Overall, it points to persistent challenges like sticky inflation, high borrowing costs, and significant downside risks, making a precarious year with modern rate growth likely. Although both Goldman Sachs and Morgan Stanley are generally optimistic for 2026, expecting solid stock market trends driven by AI-fueled productivity, strong earnings, and potential Fed rate cuts, Morgan Stanley appears slightly more bullish with a higher SP 500 target. Moreover, historically, these two giants have often expressed different views on the same issues. As such, Google and catch three key disagreements between Morgan Stanley and Goldman Sachs. For an individual investor, this isn't just noise. It's the perfect case study to build your own forecast filter. Let's see three examples. Fed rate cuts. For Fed rate cuts in 2025, both banks predicted US rate cut in 2025 but disagreed on the scale. Goldman Sachs expected a standard cut, while Morgan Stanley forecasted a much larger and faster cycle of reductions. Long-term stock returns. Their long-term outlook for US stocks were opposite. Goldman Sachs was pessimistic regarding predicting low returns, whereas Morgan Stanley was optimistic, forecasting strong growth driven by AI. 2025 US economic forecasts. Their predictions for the 2025 US economy changed dramatically due to shifting trade policies, both initially predicting a recession after new tariffs were announced but quickly revised their views to no recession when tariffs were later reduced. If the smartest people in the room can't agree and even change their minds completely, what are we as investors supposed to believe? So let's figure them like peel an onion. You are not their target. Actually, when I told my confusion to my friend, he asked, What if these giant investment outlooks for 2026 weren't really written for ordinary people? This sentence struck me deeply. Yes, most of us who reading these reports subconsciously regarding ordinary people as potential target audience for these giant institutions. However, the truth is not. Now, let's list these three institutions with several compared points. The table shows that their positioning, serve objectives, and operational strategies are all different. In short, JP Morgan Chase and Goldman Sachs are profit-seeking private financial giants, whereas the World Bank is a public interest-driven intergovernmental international organization. Comparing them is like comparing an automobile manufacturer to a public library. Though they all have bank in their names, their essences and missions are completely different. Here, we can understand in this way. JP Morgan Chase, a financial supermarket serving everyone, especially aiming to profit from the wealthy. Goldman Sachs, serving only individuals and institutions at the very top of the pyramid. The World Bank does not serve individuals. Its clients are countries in need of development and projects that can create jobs. As a result, we are not their target. We are all not their targets. I hope this explanation helps clarify the concepts. If you would like a deeper understanding of any of these institutions, such as the specific operations of investment banks or World Bank projects, feel free to drop a comment and I can provide further details. Well, after saying above, what I really want to express is, in the journey of investing, any external opinions or comments can only serve as a reference. Everything still demands on your own decisions and thinking. Next, I can show you what principles we need to follow to establish our independent thinking of ourselves. Several principles we need to follow. 1. DYOR. You've probably seen this everywhere. DYOR. Do your own research, but it's more than just slang. It's a mandatory survival skill. It's a reminder that before you trust an analyst, mine included, you need to dig into the primary sources and think for yourself. 2. Default to skepticism, not cynicism. Your initial reaction to any claim, especially from an authority, should be show me the evidence and the reasoning. This is not about being negative, but about requiring proof. Trust must be earned by logic, not granted by title. You might think like that, what's the source of this data? What might their incentive be for presenting it this way? What is not being said? 3. Seek disconfirmation, not confirmation. The biggest intellectual failure is only looking for information that supports your existing belief. You must actively and rigorously search for the strongest arguments and evidence against your position. If you cannot find a way to falsify your idea, you haven't tested. 4. Think in probabilities, not certainties. The world is complex and probabilistic. Replace right, wrong with more likely, less likely. Your goal is to make decisions with positive expected value over time, not to be proven correct every time. For example, we can use phrases like the base case is, but there is a 30% chance that. This forces you to consider multiple outcomes and their odds. Just like when two people are arguing, it's very easy to drop into the trap of, I need to prove that I'm right, rather than the best case is maybe I'm wrong, but he's not purely right. Once you drop into this trap, you can ignore all the facts right in front of you. 5. First principles thinking. Boiling down a complex problem to its fundamental, undeniable trust and building up reasoning from there. Embrace the trains of analogy. This is how it's always been done. Don't ask what's the typical PE ratio for this company. We can ask what are the fundamental drivers of value for this specific business and what are they worth. 6. Second order thinking. First order thinking is simple and creative. The Fed is cutting rates. That's good for stocks. Second order thinking asks, and then what? It considers the consequences of the consequences. We might ask, what does everyone already expect it to happen? The consensus. If I'm right, what will happen? What will happen next? That isn't obvious now. How could I be right for the wrong reasons? I think this is one of the most important mindsets that we often use for our investment paths, since what we face is a high volatile market. The last one, inversion. Instead of thinking about how to achieve success, think backwards about how to guarantee failure. Avoid those pitfalls and you are on the path to success. It's a powerful form of stress testing. When it comes to a stock, we can try on. What would make this company go bankrupt in 5 years? What would cause this trade to be a total loss? Then monitor for those specific red flags. Alright, I will continue following these trends. I hope you found this helpful. If you enjoyed this video, please give it a like and subscribe so you don't miss any future videos. Thank you so much for watching. Catch you in the next one.